So what about stagflation in 2026? You've said Brent above $120 is its own worst enemy. Could fertilizer or other secondary shocks create a cost push inflation dynamic that overrides your thesis?
Oh, sure, it could. But I think we have to put this in the context of where we've come. Remember, on the back of the biggest money pump in history in 2020, we've elevated all risk assets. And we've already had significant inflation. What we have right now in the world's second largest economy is significant deflation. You look at that Chinese 10-year note, I've been pointing this out for a little too long, but it's at 1.82%. That matters. That means something. That's despite significant fiscal and monetary stimulus running 2 to 3 times what you're seeing in the US. So they're doing everything they can to support their economy and exporting pretty significantly deflation forces, most notably in technology, renewable energy technology that's replacing fossil fuels. And what's happening now is going to accelerate that process. That's one thing I really enjoyed writing about in 2022. But this one is global. This event is global. I mean, just having price of European diesel head towards $200 a barrel is a sign that this is going to be pretty significant demand destruction. I mean, what capital investment decisions in the world are not being curtailed? What consumer on the planet is going out of the way to, hey, honey, I'm going to buy more stuff now or buy a new car? It's all being shut off. This is a classic, I think, psychological trigger for shutting down of your consumers on a global basis, in particular in this country. Remember, before this happened, consumer sentiment in this country was already pretty weak. Retail sales versus CPI were already pretty weak. Unemployment was ticking up. To me, this is a trigger. And the bottom line now is gold warned us, and the stock market's very expensive. The bottom line I was noticing is stock market volatility was just way too low. Now, it's still too low. It's picking up a little bit, but 180-day volatility in the U.S. stock market is still running near decade lows. That's to me just way too low for this environment. So my base case is starting to happen, and that stock market volatility should go up, which means a downward trend, which means all that matters. And what better trigger than the world's most significant commodity, which should use its own worst enemy, rallying at this velocity? So to me, this is as bad as it was in 2008. When I remember my signals were similar then, was when we reached $4 a gallon in U.S. gasoline for the first time. Everything, that was the trigger. That was in July. And I'll put that in context. That happened in July. Crude oil reached 147 and CPI peaked at 5.6%. Right now, we have CPI, our analyst, Anna Wong, thinks by the March CPI is probably going to pop up to 3.4%, which is about half of what it did in 2008. It's just early days, but history can repeat and can rhyme. This is a rhyme, but the difference back then, I think, was back then the stock market was running about 1-to-1 versus GDP. Now it was earlier 2.3 times. So that's why I'm kind of fixated on that. And like when people for the last year or so would ask me about industrial metals and they put a bullish case about copper, I'd say, okay, so you're bullish the stock market. Or if they give me a bullish case about cryptos, I said, so okay, you're bullish the stock market. And they would ask me sometimes, why did you say that? Because that's all that matters. Now, for those, almost all these assets, almost all risk assets, certainly copper, crude oil's the triggers, and you have to expect the stock market to go up. So this is, to me, is that trigger for everything to kick in. And we've been warned, like gold warned us last year. So where do we go from here? I think this is a year to be looking to just be risk off and hang out in treasuries.